All right, great. Good afternoon, everyone, and welcome to Wolf & Company and R&T's webinar on the topic of FDIC broker deposit rule updates. My name is Stephanie Creedon, and I'm a senior marketing specialist at Wolf & Company, and I will be hosting today's webinar. During today's presentation, members from R&T and Wolf & Company will be discussing the Federal Deposit Insurance Corporation updates surrounding broker deposit rules in an effort to modernize and accommodate fintech partnerships. Today, you'll receive an in-depth look at this new framework and how it impacts your organization. Our presenters will discuss the recent changes to the rules, exemption requirements, and crucial implementation and sunset dates to be aware of. But before we go and get started, I do just want to review a few housekeeping items for the audience. A reminder, today's presentation will be recorded and available after the conclusion of the event. All attendees and anyone who registered for the webinar will receive a copy of today's presentation as well as a link to the recording. The format will be structured as a Zoom webinar. All attendees will be muted throughout the presentation. If you do have any questions, please use the Q&A button at the bottom of the Zoom control panel to submit any questions throughout the presentation. We will be taking questions as they come in, as well as we have allotted some time at the end to answer any additional questions. The presentation will be about 1 hour. So like I said, we do have some time for questions at the end. And with that, I would like to introduce today's presenters. Joining us from Wolf & Company is Jim McGough, a principal in the audit group. And joining us from R&T is Joe Jerkovich, and he is the CEO and EVP at R&T. So with that, I am going to pass it over to Jim to kick us off for the day.
Thanks, Stephanie. Good afternoon, everyone. Thank you for joining. I'm an audit principal with Wolf & Company. We are a regional CPA and consulting firm. We do business with over 300 financial institutions providing audit, risk management, and tax services. And we are very interested in these new rules because it's a chance to help our clients. So we're always looking for that. As an auditor, I frequently get questions on broker deposits and the classification of them. And I am not an expert. So every time it's a deep dive into the call report instructions to get the answer. And so I'm pretty excited about today. These new rules, they are favorable, but they're not immediately accessible. Unless you're deep into it every day. So we are lucky to have an expert from R&T to help us understand what is important and what is beneficial in this revised framework, and to make it accessible for us. R&T, they are a market leader in FDIC insured bank sweep programs with over $100 billion in assets under administration. They've been in this space since 1974. Through their sweep programs, R&T helps financial institutions, broker-dealers, and trust companies gain access to high levels of FDIC insurance up to $35 million. They are a thought leader on the topic of reciprocal deposits and on broker deposits, so they're at the right place at the right time. And it is my pleasure to welcome Joe Jerkovich, the Chief Operating Officer of R&T, to take us through these very important rules that become effective next week.
Well, thank you very much, Jim, and welcome everyone to the presentation. As you said before, please submit your questions. We'll do our best to get to each and every one. Let's start first with the stigma of broker deposits. Banks and regulators have a negative view towards broker deposits, primarily because they're not considered to be a reliable source of liquidity. They're not there when you really need them. To the extent that you have concentrations, it can lead to higher FDIC assessments, and it's only available to well-capitalized banks. So that what you see is that most banks who have broker deposits only have up to 10% of their deposits in them. And there's even more banks that don't have any exposure to broker deposits at all. And that was one of the concerns of the FDIC, is that, were these rules outdated? Did they need to be refreshed? Because remember, they were created in 1991, and this is before the existence of broker sweeps, before a lot of the benefits we're seeing in the fintech space, before stored value cards, etc. Were they clear enough? Were practitioners able to rely on them consistently? Was it overly difficult for banks that are in rural communities and inner cities to get access to certain deposits. So this is just making it more difficult for them. We think the FDIC made a tremendous move forward with these rules in meeting customer needs, modernizing the framework, and making the overall rulemaking extremely clear and transparent. So before we get into the rules, let's just go over the environment. As of June 30th, 2020, we had 15.6 trillion overall deposits, of which 1.2 trillion were broker deposits. Interestingly, only 38% of banks actually held broker deposits, and a large majority of those were on the larger end of banks. So that a major theme of this presentation is going to be that because of these new rules, there's a new channel of core wholesale deposits in the hundreds of billions that will be accessible to all size banks throughout the country from broker-dealer sweep programs. And this is a consistent theme I'll discuss throughout the presentation. And when I say core wholesale deposits, what I'm referring to are deposits from a third party, like a broker-dealer, and not through the traditional branch network of a bank. So let's get started on the new rules. They were issued on December 15th in final form by the FDIC, subsequently into the Federal Register on January 22nd. They become effective next week, April 1st. Between April 1st and the end of the year, there's a transition period where that the existing guidance and the new guidance will be effective. But come the end of the year, effective January 1st, 2022, only the new guidance can be relied upon. Now, in terms of the rule itself, there are no fundamental changes to the broker deposit concepts. However, there are some really important clarifications, which is going to be the focus of this presentation. So that we're going to discuss this in four discrete sections. We're first going to talk about the change to the deposit broker definition. We're then going to talk about the 14 primary purpose exceptions. We're then going to talk about the impact of failing to adequately capitalize. And then we're going to cover some other definitions, effective dates, etc. So let's move on to section number 1. So again, the definition of deposit broker, not much has changed here at the high level. But again, there's been some very important clarifications for the first two items here. Whether a third party is engaged in the business of placing deposits or engaged in the business of facilitating the placement of deposits. And we're going to go into detail for each one of those. So when a third party is engaged in the placement of deposits, two things have to be in place, or they have to do two things. One, and what types of entities does this apply to? Broker-dealers, trust companies, custodians. And what's very interesting as a result of this rule is that when we get to the next section, there's a very important primary purpose exception called the 25% rule, where that even though these institutions, these broker-dealers, trust companies, and custodians are technically, because of where we are right now, a deposit broker, when we get to that section, you will see that these institutions have a pathway to actually not be considered a deposit broker. That is brand new. That did not exist before this rule. In the prior rules, this was the end of the story. Broker-dealer, trust company, custodian, they were a deposit broker. So stay tuned for the discussions of the primary purpose exceptions, which we'll get to in a bit. Before moving on, the other important clarification was that if there is an exclusive deposit arrangement, meaning that the third party is only working with one bank, then they can't be a deposit broker, because that requires them to work with multiple banks. So that this is extremely important in the context of affiliated groups, where there's one bank, because again, there's not a special affiliated bank rule or group rule in this rulemaking. The one that exists today that a lot of banks rely on as part of the advisory opinion process 0502, that's going to be going away. So that worked in a very small context for the affiliated banks and affiliated broker-dealers, but that's going away. So that in its place, affiliated groups will have this rule to use to get to a similar result, and we'll go through that a bit. Also, where it's very important is for challenger banks. And again, a challenger bank is it's not really a bank, but it's a fintech that is partnered with a bank. And if that fintech has an exclusive relationship with the bank and there's deposits coming into that channel, well, then that bank can treat those deposits as core as well. So again, just look at that a little more closely. This is from an example that the FDIC provided on their website last week. And again, it's in the affiliated group context. There's multiple affiliated banks, multiple affiliated operating companies. And what's clear is that if the operating companies spread their deposits among the affiliated banks, there's no special rule for affiliated institutions. They're going to be considered a deposit broker absent a primary purpose exception or other exception. Whereas if there is a way to align the subsidiaries on a one-to-one relationship with their affiliated banks, then they would be able to rely on this rule. Just something to be aware of. So moving forward, the first part of the definition of deposit broker, engaged in the business of facilitating, actually this is the second one. We discussed the first one already with respect to the broker-dealers. This relates to other institutions, other third parties. And this has been really become an important focus because, as I said before, with respect to the broker-dealers and trust companies, they're not going to be deposit brokers because of this exception that I'm going to discuss later. So that as a result, any other third parties involved between a bank and the ultimate customer is going to be highly scrutinized in terms of, because it only takes one deposit broker to taint a deposit to be brokered. So let me describe, and I think this would be a helpful example. I'll describe how does a broker-dealer sweep program work. Broker-dealer has customers. On behalf of their customers, they're investing funds in equities, fixed income, mutual funds, ETFs. And at the end of each day, the excess cash in their customers' accounts is swept into, in many cases, these broker-dealer programs. And how do they work? Well, the broker-dealer sweeps them to banks. In most, if not all, of these programs, there's what's called a sweep administrator. And those are the parties that are involved. You have the broker-dealer, and again, we kind of addressed that in the first rule. Now you have the sweep administrator, which will be, when we're analyzing this, facilitating the placement of deposits, we're going to look at that very closely. And then you have the banks. So that, let's dig into this a little bit more. So the general rule here is that if a third party to be considered a deposit broker, if they do one or more of the three activities, whether they have the ability to close an account or move an account, if they have the ability or power to negotiate terms, rates, etc., or if they're a matchmaker. We're going to address each one of these individually. So with respect to the legal authority to close accounts or move funds, this one's pretty straightforward. You either have this power or you don't. Sticking with our example with the broker-dealer sweep model, looking at the sweep administrator, in these programs, the sweep administrator never has the ability to open or close accounts. That is in the purview of the broker-dealer. They're the only parties that can move funds, etc. But this is an important one to consider, but largely not applicable in the context of these broker-dealer sweep programs. So then we move to the next one, which is also very important, negotiating or setting rates. Now, what's important here is that you have to view this as sort of a before the rule and after the rule. As I said before, the broker-dealer trust company, they're going to have this exception that we're going to talk about later. So that in the past, though, they didn't have that. So when you were analyzing whether there was a broker deposit or not, the analysis basically stops. Well, if the broker-dealer is a deposit broker, end of story. There really wasn't a lot of emphasis based on, well, what is the broker-dealer doing versus what the sweep administrator is doing, who's speaking to the bank. It just was not a relevant conversation because, the story ended by the fact that the broker-dealer was a deposit broker. But what I'm telling you now is that when we get to it, they're not. So that all focus now goes on the sweep administrator or this other third party. What are they doing? Are they negotiating? Maybe historically they have negotiated because it hasn't mattered. And in fact, R&T is a sweep administrator, and very clearly in the past, we have been very involved in negotiating rates with banks, but it's now at an inflection point. There wasn't a question before as to whether that was a problem or not, or any way impacted the classification of these deposits. So what we envision going forward is that the banks, they're going to want core deposits. And again, this is a tremendous opportunity. It's hundreds of billions of dollars in these programs. Very beneficial to the broker-dealer as well. Whereas we expect going forward, and we're starting to see this already, is that broker-dealers and banks are starting to negotiate directly, and as a direct result of this rulemaking. So let's move on to the last category here, matchmaking. And again, this is a brand new term that was introduced in the rulemaking in December. And what it basically means is that if I know the needs of the bank, and if I know the needs of the broker-dealer, and based on that information, I propose an allocation, well, then I'm acting as a matchmaker. And in the rulemaking, the FDIC made it very clear that this concept has particular relevance in the third-party broker sweep, this broker sweep with unaffiliated banks in that model. And that, there's got to be a distinction between, and again, using this before and after kind of paradigm, before it really didn't matter. Again, like I said, the story ended, the broker-dealer was the deposit broker. So that in many cases before this rule, in a lot of cases, Rich and Tang was involved in those discussions right in the middle and did perform the matchmaking role. But what is the most important item here that's been identified by the FDIC is that if that results in deposit allocations, so it's really the party who proposes the deposit allocations. And again, if that's Rich and Tang in terms of looking at the needs of both parties and it results in that allocation, then we're acting as a matchmaker. However, how we expect to see this moving forward is that, again, banks are going to start proposing that allocation. They're going to start negotiating directly with the banks, as we said before. We believe they're also going to start proposing the allocations to R&T, or the sweep administrator, so that R&T, instead of being a matchmaker, will instead be acting more in a passive capacity. And those are the important concepts for matchmaking, is who is proposing the deposit allocations, and is that other third party, in this case the sweep administrator, acting in an active or a passive capacity.
Joe, it looks like we had a few questions come in surrounding the matchmaking.
Sure.
So the first one is, does R&T's role in administering the accounts for FDIC insurance count as a deposit allocation under the matchmaking prong?
Two things I'd mention. I mentioned before the whole concept of if I know what the bank needs and the broker-dealer, and I'm based on that information, we're proposing allocations. It's very clear whoever proposes the allocations, we believe, is providing the matchmaker. Or that to the extent that Rich and Tang is not proposing that allocation, we don't believe they're acting as a matchmaker. This question goes, I think, a layer deeper and said, because one of the roles that we play in these programs, and one of the benefits to customers is that we also take the underlying customer data and we make sure, we have a process to make sure that all of the underlying customers are FDIC insured. Give you an example. how we see this working. So that going forward, we would expect to see a broker-dealer propose an allocation, put $50 million at Bank ABC. They provide that instruction to the sweep administrator. They update their allocation accordingly. Similar Bank XYZ, put $100 million, and again, this is coming from the broker-dealer to the sweep administrator. So that at the end of the day, whenever the allocation is run, Bank ABC is going to have $50 million. Bank XYZ is going to have $100 million based on the instruction from the broker-dealer. However, as part of that role of making sure the customers are fully FDIC insured, it is possible that for John Doe today, when we allocate his funds, he'll be 100% at Bank A. Tomorrow, because of changes in the customer mix, when we run our allocation, he may have half his money at Bank A and half his money at Bank XYZ. And again, to be fully FDIC insured. However, that has no impact on the fact that Bank ABC at the end of the day will still have $50 million and Bank XYZ will have $100 million. So that we do not consider the allocation process at all, which is a non-discretionary allocation that is performed. We just consider that as part of our normal everyday administrative service. So that has nothing to do with matchmaking. Hopefully that answers your question. Are there any others?
And it looks like we just got one more in. And the next one is, will most sweep administrators be considered a facilitator of deposits and therefore a deposit broker under the new FDIC rules?
I think it's probably pretty clear where I'm going to go with that. Again, I could only speak to R&T. Each bank, and I think the important point is that each bank is going to have to make that determination. So each bank is going to have to look at the third parties involved and determine whether that third party has the ability to move, close accounts, has the ability to, or has negotiated terms with the bank, or is acting as a matchmaker. And as I said before, at the risk of repeating myself, we're already seeing this, a fundamental change in how these programs are going to be operated, where that we expect that in those situations where poor treatment is desired, is that the broker-dealer is going to negotiate terms, and that they will be proposing allocations. And therefore, we do not expect that sweep administrators necessarily and likely won't be considered deposit brokers going forward. Okay, I think we should move on to section 2, and this is really where we get to some of the very exciting new primary purpose exception. But first, let's start at the what hasn't changed. And again, overall, in terms of the general framework, there hasn't been much change, but there's just been a tremendous amount of clarification. So when we look at number 9, this is where the FDIC has provided us with 14 pre-approved primary purpose exceptions, 2 of which require notice. The other 12 do not require any notice or application. And the general sense here is that, or how this works, is that if the primary purpose of a third party is not to place deposits at banks, then they're not a deposit broker. So let's get started. And I've kind of built this one up a little bit. This is absolutely the most important aspect of this rule. The first primary purpose exception that we're going to talk about, which is called the less than 25% total assets under administration rule. It primarily relates to institutions that when you look at their customer base, if less than 25% of their assets under supervision are placed at banks, then they're considered that their primary purpose is the investment of their customer funds and not the placement of deposits at banks. Therefore, they're not considered a deposit broker. Just think about that. Who does that impact? Broker-dealers, custodians, trust companies. And if you look at these institutions, how much is actually at banks? 25%? It's more like 10, it's more like 5% when you look at a typical broker-dealer or trust company. So that there's no doubt in my mind that all these institutions will qualify for this new primary purpose exception. So that's groundbreaking in terms of, although we talked before that these broker-dealers and trust companies might be considered to be deposit brokers, well, they're not anymore under this rule. And this is what opens up the floodgates to a $1 trillion market and sweep deposits, where that, through these broker-dealer channels. And again, a large part of that trillion does go to affiliated banks like the Schwab banks and the TDs and Merrill Lynch, Bank of America. But there's still hundreds of billions of dollars of deposits that are available to banks across the country to be treated on a core wholesale basis as a result of this rule change. And the other thing to notice about this rule is that this one does require notification to the FDIC. It's not an application. We're going to go through that process, but before I do that, I want to cover the other primary purpose exception that does require notice as well, and this is a very important one in the fintech space. This one targets banks and fintechs that primarily focus on enabling transactions and payments, your debit cards, stored value cards, prepaid cards. And this was a groundbreaking development as well, because for many years, there's been a push, did it really make sense that prepaid card deposits, stored value card deposits were treated as brokered? Well, this is a direct pathway to get to a core treatment. It really just focuses on two things. All of the assets have to be in transaction accounts, and the underlying customers cannot earn any interest or any other compensation. And if you meet those two requirements, then you're able to take advantage of this new primary purpose exception. So let's go a little bit more in terms of what the notification requirement entails and who could make that filing. Either the third party, the broker-dealer, the fintech, the trust company, or the banks. Each of the banks can make this notice filing. We expect that in most situations, it's going to be the third party that makes this election. It just makes more sense. What's also important about this notice filing is that once it's filed, there's immediate acknowledgement from the FDIC, 5 minutes, 10 minutes, where that the broker-dealer, and again, doesn't have to wait for the application to be approved. It's already pre-approved. They just have to go through this notice process. They get an immediate acknowledgement, and then they could start saying, we're not a deposit broker. And this will start April 1st. Okay. Now, in terms of the content of the notification, what do they have to disclose? This is all pretty straightforward information. I'm not going to go through each of the items here, but business lines we'll talk about later. These elections have to be done at the business line level. And then the other important item here is that the third party, and just stick to our example, the broker-dealer, trust company, or custodian agent, has to disclose whether there were any third parties involved that may be a deposit broker. So like in our example, the sweep administrator. Broker-dealer would say sweep administrator XYZ, provided services to this program. Then it's up to the bank. Each bank in the program must then go through the analysis. They already, the broker-dealer is taken care of. They got the acknowledgement. They're not a deposit broker. Don't have to worry about it. Then you have to focus on that third party, or the sweep administrator in this case. And they'll go through the analysis we went through before. Can they close, remove an account? Can they negotiate? Are they a matchmaker? And then based on the analysis, they make a determination as to whether they are a deposit broker. And if they are, then it's a broker deposit. If not, then it's a core deposit. And then other things to notice about the notice filing is that there's a one-time application, the one time at the beginning, but then each quarter you have to provide quarterly updates. And not surprising, the FDIC has the ability to revoke this if they find that the information was inaccurate or the reporting was not completed. But that's about it on notice filing. So now we're going to bring everything we've talked about so far together in a complete example. And really ask the question, how can banks now receive core deposits from a sweep program? So on the left-hand side, you have financial intermediary A, could be a broker-dealer, trust company, a custodian, and there's no third party involved. This financial intermediary did what they were supposed to do. They went to the website, they got their acknowledgement, gave that acknowledgement to the banks. We're done. That's a core deposit. Simple. Go to the right-hand side. Same exact fact pattern. Only one difference is that there's a sweep administrator involved. Again, how this works, financial intermediary, you don't have to worry about it. They provide the certification to the banks. But each of these banks, banks 1, 2, and 3, have to then do an analysis and just say, was the sweep administrator, were they facilitating the deposit? Going through what we went through before, ability to move, close an account, did they negotiate, were they a matchmaker? And based on that determination, if they facilitated the deposit, it's a broker deposit. If they did not, it's a core deposit. And again, before this rule change, just to emphasize, there was no, this was not available. The story ended with the fact that the broker-dealer was a deposit broker. End of story. The situation on the left-hand side, broker deposit. And didn't really matter what the sweep administrator is doing. So that in terms of what the banks need to do, just to focus on that a bit, again, the financial intermediary, first thing they do, they get their acknowledgement, they're done. Then they just have to, for each third party involved, go through the analysis, ask those questions, and then that's how they determine if the deposit is brokered or core. What we expect is that based on these new rules, there's going to be a fundamental change in how these programs operate, which will encourage banks and broker-dealers to work more closely together to negotiate rates, terms, and to propose deposit allocations. And to continue with the other primary purpose exceptions, remember there's 12 more. The big difference here is that no notice is required. The banks can just treat these as core. You have to be cautious whether there's any third parties involved. Same analysis. If there's third party, you're always going to do that facilitation analysis. But generally speaking, all these listed below are core. A question I've received related to some of these accounts, particularly these tend to be larger accounts greater than 250,000, and in many situations are paired with what's called a reciprocal deposit program. Now, back in 2018, there was a Senate Bill 2155, also called the CREPO Bill, subsequently adopted by the FDIC, where there's a limited exception for reciprocal deposits to the extent that the lesser of $5 billion or 20% of liabilities, reciprocal deposits are not treated as broker deposits. They're treated as core. And the question I've received is, did this rule impact that in any way? No, not in a negative sense. You know, that rule is still available, reciprocal deposits are still core, but it actually helped for those banks with reciprocal programs, because in order for that reciprocal deposits to be core, the originating relationship at the bank, you know, this homeowners association or the title companies or the like-kind exchanges, that has to be a core relationship. And what this rule does is that makes it very clear that these 7 on this page, are core relationships and pair very nicely with reciprocal deposit programs. But there are 5 others. Again, these tend to be ones with smaller underlying account balances, but also very welcome in the industry. HSA accounts, mortgage servicing accounts, so on and so forth. Another question that I did receive about HSA accounts in particular, you know, given the current environment we're in with banks being overfunded, they were thrilled, you know, that HSA accounts are now considered core. But the question was, well, what if, in terms of managing my balance sheet, I want to put those temporarily on the balance sheet of another bank because I'm just way overfunded. Can that other bank treat those deposits as core. And a couple things there, to consider. I mean, I think interestingly, in that case, the originating bank would still control those deposits and can pull them back. So ironically, I think the originating bank is actually acting as a deposit broker. But also, a lot of times banks will use bank networks like R&T's DDM program or Interfi's ICS program to send these on a one-way basis to other banks. And the answer there is also that they'd be broker deposits. But as we go forward, so good news, we have 14 pre-approved primary purpose exceptions. The application process will provide the ability for there to be more in the future. This process is expected to start no later than September 2021, with final determinations provided by the beginning of next year. And what's nice under the new rulemaking is that they will be maintained all in one place, full disclosure, full transparency. And I think this would be a good time, Stephanie, if we wanted to start with any questions.
Yeah, let me pull up the questions. It looks like we did get a few that came in during this section. The first one being, oh, sorry about that, I'm not on video. Not that it really matters. But what will happen to the rates paid by banks taking deposits from these programs?
Again, we expect that there's going to be an increased demand for these deposits, these hundreds of billions of core wholesale deposits from these third-party sweep programs. How much they're going to increase, 10 basis points, 20 basis, I have no idea. But it's also going to be impacted. I do expect it to have a positive, an impact to increase these rates over time. But it's also going to be a function of, how funded or underfunded, overfunded banks are, where we are in the business cycle, so on and so forth.
Great. And the next question we received was, why is this beneficial for broker dealers?
Well, I think one reason is that the rates are likely to increase for these programs that they're earning from banks, which will allow them to pass on more yield to their customer or increase their fee revenues. But more importantly, I think particularly given the year that we've gone through, where banks are tremendously overfunded and finding capacity for these programs has been a bit challenging. The fact that these deposits are going to be moved from broker to core, we think will be we think that the 38% that are just the statistic in the very beginning where 38% of banks take broker deposits. Well, what about that other 62%? Those other banks who don't touch broker deposits now will feel comfortable getting access to this market, so that there's going to be a tremendous influx of banks into this space wanting to participate in these core wholesale deposits, so that alone, that additional capacity that's going to be available for these programs is going to be a tremendous benefit.
Great, thanks, Joe. And I think we have time for one more question to squeeze in here. Do all banks participating in a particular program have to treat these deposits as core?
No. Again, each bank separately makes its own determination. For a variety of reasons, there are going to be banks in these programs that treat them as core, treat them as broker today, and for one reason or another, will continue to treat them as brokered. And it may be based on, with respect to those banks, certain services are being provided, whereas other banks, the sweep administrator is not involved. It also is a factor of, some banks, if they're not highly concentrated in broker deposits, then they're not really going to care whether, who's negotiating, maybe more of a convenience thing. There's also a large subset of banks that really just care about Basel, or that something's core brokered, not really the driving issue, as long as it doesn't impact their runoff rates. So that the answer is no. We think that most banks going forward will certainly want to treat these as core, but there will be the exception. So let's move on to section 3. And Stephanie, how are we doing for time?
We've got about 20 minutes left. There were a few additional questions that came in that I'd like to we'll continue on your presentation, and hopefully we'll have some time at the end to answer those.
Okay, well, that's very helpful. So the next section we're going to talk about, and this is a short one, is the impact of falling to adequately capitalized. And again, this is a very, very important clarification. Under the old rule and new rule too, I mean, it's always very clear what happened for, say, a 3-year CD, is that a bank that's been downgraded can hold that deposit to maturity, but just can't roll it over. But there's always a question mark under the old rules. What happened for a non-maturity deposit? The general think was, is that upon such a downgrade to adequately capitalized, that those funds needed to be immediately returned, thereby taking a bad situation and potentially making it much, much worse. But the really helpful clarification that the FDIC provided, and this will be well received by ALCO committees and contingency funding teams and so on and so forth, is that the general rule now is you just can't grow those amounts. You can maintain them indefinitely, you just can't grow them. There's a fine point for certain types of accounts known as agency accounts, where that, and these are the types of accounts that a broker-dealer would set up with respect to their programs, where that they're held for the benefit of their customers. And the one fine point there is, again, they can't grow, but you also cannot add any new underlying tax IDs or beneficial owners. So that, again, the same general rule, I think it's very helpful. I think in terms of, again, speaking for R&T, and I assume most administrators can do this too, that, you know, that's not a problem in terms of, you know, helping the banks identify and ensure that no beneficial owners are added. Now, in terms of, just to be clear, this discussion is not relevant to non-brokered deposits. A little bit of a fine point here too is that, and it's a little confusing point, is that it could apply to an otherwise core deposit, that if a bank is downgraded to adequately capitalized, and if the rate on that deposit is higher than what is allowable under the new interest rate rules, then that would become a broker deposit and subject to this rule. Okay, and I think in the interest of time, Stephanie, I think we're going to move forward to section 4. Okay.
Perfect.
All right. So as I mentioned before, under the 25% rule, one of the rule is identified at a business line level. And again, we don't think this is a major problem. It's pretty self-evident what the business lines are in a lot of these situations, but it's something the banks need to be aware of. And you just got to be aware of when third parties try to cherry pick groupings of businesses so that they meet the 25% requirement. So you see in this example, diverse co, where you have core broker-dealer business, 9% allocation to banks, advised IRAs, 4%. Well, then you have private wealth and trusts, 42.5%. On a standalone basis, they clearly don't qualify. If diverse co were to submit its notice claiming 11.47% for the entire 3 businesses, this is a situation where the FDIC might scrutinize the applicability to the private wealth and trust group. Again, just something for the banks to be aware of. Excuse me. In terms of the involvement of third parties, we've spent a lot of time speaking about, you know, a specific example involving sweep administrators, but this applies to all sorts of third parties, whether it be listing services, investment advisors, custodians, referral agents, payment processors. The same discipline has to be taken, where that for each third party, because again, it only takes one third party to be a deposit broker to taint the entire deposit to be brokered, For each one, you have to go through, do that facilitation standard analysis. Can they close move accounts? Did they negotiate rates? Are they a matchmaker? So on and so forth. Or maybe they're eligible for primary purpose exception. But again, it's up to each bank to do that. Other things to consider as part of this rulemaking: make sure, to the extent that you're relying on the notice filing of a broker-dealer in your agreements, make sure that you have access to that information. There's also a see something, say something standard where the FDIC expects its banks to do the right thing in terms of applying, these rules and make any necessary notifications. In terms of important dates, we did go over these before, but I'll just say them again. The effective date is next week, April 1st. Probably the more important date for banks is June 30th, which will be your first call reporting date. The start date for notices is April 1st, again, next week. I spoke about the getting compliance period, where between now and the end of the year, you're able to rely on both sets of rules, and then the sunset of existing guidance come January 1st, 2022. The FDIC has already issued modifications for the June call reports. Not surprisingly, it's focused entirely on sweep deposits in the 25% rule. And again, this is another, I think, source of evidence that we feel supports our conclusion that as a result of these rules, there's going to be a huge availability of these core wholesale deposits in hundreds of billions of dollars. Now, in terms of trust company considerations, under the prior rule, there's very clear path for trust departments in their deposits at banks to be treated as core. It wasn't so clear for other entity structures, wholly owned subsidiary trust companies, independent trust companies. Under this rule, these three entity types largely achieve parity. So that it might not necessarily be the same path to that parity. Like, for example, we expect that most trust companies, like the broker-dealers, will have a similar asset mix for their customers, and it should be no problem whatsoever to meet that 25% rule. And as a result, should not be considered a deposit broker. For local government investment pools, we think it's a little more challenging, particularly for the 25% rule, given the mix of their investments. They may run close or exceed the 25% rule. So we're not sure if that channel is going to be a viable source for them. That said, we think that is probably a more likely source of achieving core deposits than going through the facilitation standard. We think that will be a tougher test. Other things to note when you're looking at a sort of a investment pool is, how do they determine the business lines? Is it at the fund level? Is it at the category level? Is it the overall complex? And I think their common sense and consistency should be a good guide. And don't be surprised that for some of these investment pools, if there arises a 25% limit on bank deposits, so that they can avail themselves of the 25% rule. And just other matters, the FDIC did postpone their deposit assessment updates. They did issue their interest rate restrictions alongside the deposit broker rules, or broker deposit rules. Obviously, we did not discuss them in detail. That's certainly the subject of another webcast. But we did mention them a little bit, I guess, in the definitions. And before we go to questions, and at the risk of repeating myself again, the primary takeaway is that these new FDIC rules have opened a real pathway for banks across the country to access hundreds of billions of wholesale core stable deposits. There will be a fundamental change in the operations of these sweep programs to achieve this beneficial result. The broker-dealers, the trusts, will want to negotiate directly with banks. It's in their interest. The broker-dealers will want to instruct deposit allocations. It's in their best interest to do so. The sweep administrators, of course, are still going to play a very important role, but they're going to play a much more passive role in these areas than they have done in the past. And with that, I thank you for your time and open for questions.
Great, thanks, Joe. So just circling back to section 3, how are these accounts titled for FDIC pass-through coverage?
Sure.
How are these accounts titled for the FDIC to pass through coverage?
Gotcha. Yeah, that's a very important consideration, is that, for these agency accounts, it's very important, and there's a lot of guidance here provided by the FDIC, that there just be indications of multiple levels of fiduciary relationships, so that titles to the such as broker-dealer for the benefit of their underlying customers, there's multiple layers of ownerships, and there's varieties along that same theme.
All right, great. And I'm gonna, there's a few other questions that had come in during different parts of the presentation. So I'm gonna circle back to what I believe was section 1.
Okay.
And the question is, for the use of one IDI, what about a backup bank for contingency purposes, but they require a guaranteed amount of volume, say 10% to maintain the piping for the activity? Would you need to get a primary purpose exemption for this? Or is the rule maintain a hard line on only using one IDI?
Again, very interesting question, excellent question. My understanding is that it's a hard line, is that you either have an exclusive deposit relationship or you don't. But it's interesting in terms of, it's one thing to abide by the rule, but is that the tail wagging the dog? I mean, obviously, from a business perspective, you're going to want to have the assured capacity and avoid the concentration. So it's a balancing act. But in terms of just focusing on the rule itself, I do believe that it's an exclusive. There's a requirement that it's an exclusive relationship, so you technically don't have that ability to decide and move the deposits between multiple banks. So it's a very good question.
Okay, great, thanks. And our next one, how will deposits be viewed if a challenger bank has 2 or more issuing banks?
Well, I think there you have to look at, in terms of the, the exclusive deposit rule, that's probably not an option for you. But again, you have to look at the other notice files called the enabling transaction rule, where that, as long as you are putting all the balances in transaction accounts, DDAs, and there's no interest or compensation being paid to the customer, then they should qualify for that. In addition, I'll make a note here, I didn't mention this on the slide, but the FDIC is cognizant that it's not such a bad thing to want to pay your customers a nominal rate of interest. In the rulemaking, they said, in that situation, and there's a few other requirements, there's going to be an expedited approval process where that maybe it all has to still be in DDAs, but if only a nominal rate of interest and there's certain other requirements and those are met, I think there's a number of transactions rule as well, that would qualify on an expedited basis. And I'm not sure what that means. It's certainly not 120 days, but it's something south of 120 days in terms of getting approval for that. But it would require a separate approval.
Great. And our next question is from earlier in the presentation during the first portion or second portion. Would you see these deposits reported on the new call report as fully insured non-affiliate sweep deposits or designated exception sweep deposits?
I think it's going to be one of those situations, and you kind of had a similar situation with reciprocal deposits, where you report them in 2 places, where you have a total and then you report the brokered again. I think here's the same, where that I think you'd report it in 2 places, where that you would report them as part of the sweep section. And then to the extent that the designated exception applies, you'd report them again down there. And then, we also have questions, and we're working with counsel in terms of that definition of sweeps. Is it just broker-dealer sweeps? Is it trust sweeps? Is it reciprocal sweeps? And I think it's a pretty broad, the way it's drafted right now, it's pretty broad. But to answer the question, I think you'd report them to the extent they're both applicable in both spots.
Great. Next question is, this came in most recently in the last few minutes. Can you discuss more about the application referenced in the earlier slide?
Yeah, the application process is, again, the FDIC, under the old rules, the process for getting a primary purpose exception was primarily through the advisory opinion process. And, it was an exercise, and being in the space, it was very challenging. You had rulings that were 1981, 91, after this rule, before that rule, sometimes conflicting. Where in this rule, what's very helpful is that goes away. By the end of the year, that will go away. And all of the approved primary purpose exceptions will be in one place. And they gave us 14 right away, pre-approved. Now, this application process allows there to be more in the future. I think the FDIC fully understands that, they got 14, and we appreciate the 14, that there's probably another 14 that they didn't get. But over time, they will add to it to the extent that it meets, the overall objective and safety and soundness of what they do. So that in terms of the application process, there was some confusion in terms of, does that start right away? Is it not going to start until September 1st? And I think it's somewhere in between. I think what I feel comfortable saying is that they're setting it up in a way such that by the time of the sunsetting of the old rules, if you submit your application by September 1st, they're going to endeavor to get you a final determination by the end of the year. I hope that's helpful.
Thanks, Joe. I do want to be respectful of everybody's time who was able to join us today. So it looks like we have time for one more question. It's a multi-layered question, so just bear with me while I recite it to everybody. All right, Joe. So a fiduciary that holds accounts for underlying customers to facilitate payment transaction may open an omnibus account at a financial institution and negotiate a deposit interest rate for the fiduciary to earn. Nothing is passed on to the underlying customers. Is this rate negotiation under facilitation guidance?
I'm not sure I fully understand the question, but let me take a shot. I think one thing that's really interesting here in the new rule, particularly with the primary purpose exceptions, is that there used to be a lot of focus on the fees earned by the third party from the bank. And there's a lot of focus on what form that took and so on and so forth. That's largely gone away. The focus now seems to be more on the compensation or interest earned by the underlying customer and not so much on the fee component. And it sounds like in the example that the relationship between the third party and the bank, that they're earning fees, the underlying customers are getting zero. It seems to me that may qualify under that enabling transactions test. Again, I think the only other requirement would be it would have to all be in operating accounts. And if you could argue that it's in a business of enabling transactions. I hope that's helpful.
Great, thank you, Joe. No, I'm glad that you were able to answer the question after my long-winded story behind it. So I just want to thank everybody for joining us today. As a reminder, I knew a few people sent questions in that may have not gotten answered. We will be following up with any questions that have come in. In addition, all attendees will be receiving a copy of the presentation as well as a link to the recording to either watch at a later date, pass along to a colleague. And we really appreciate your participation, and we hope to see you at any future webinars that both Wolf and R&T present together. So on behalf of Wolf & Company, I just want to thank Joe for his expertise and insights into the broker deposits, the FDIC broker deposits, as well as thank Jim for his time on the call as well. So I hope everyone has a great rest of their day, and we'll talk to you soon.
Thank
Thanks,
you all
everyone.
for putting it together.